Good afternoon and welcome to our roundtable where we're going to be exploring and discussing possible implications of a Biden tax plan. Really happy that you could all be with us today. I'm Jody Skinesny and I'm the Vice President of Member Engagement here at the MICPA. I just want to touch on a few housekeeping items real quickly before we get started. First, you will probably get a notification letting you know that this session is being recorded and having to agree to participate, knowing that. It will be available on our website following today's presentation and discussion. You will receive an email with the presentation slides along with a link to where you can find that on our website should you want to either go back and review something or share it with colleagues. Additionally, we do ask that everybody remain muted because we do have close to 200 people participating today, which we're pretty excited about. If you do have a question, we do want this to be interactive. Please type it into the chat. And so if you just move your cursor, you'll see the chat at the bottom of your screen. Go ahead and type your question there to everyone, and the moderator and the panelists will kind of monitor the chat throughout the presentation to make sure that we get to as many questions as possible. So with that, I would like to turn it over to Rachel Reardon. And she is, well, she's kind of the head of and almost the entire government relation department here at the MICPA. Rachel's going to be moderating our session today. Rachel, take it away.
All right, good afternoon, everyone, and thanks for giving us some time this afternoon. As Jody mentioned, I'm Rachel Reardon, the Government Relations Leader here at the MICPA. If you have any questions after the session, feel free to reach out to us. I know it's renewal season, so if you have questions about your license, reach out to me as well. I just had to put that little plug in for don't forget to renew your license in July, and don't forget to earn your CPE by the end of June 30th here. So we're really excited about this panel that we have today. We have some experts on both the federal tax side and state and local to talk about implications on the SALT side as well. So I'll do some quick introductions and then I'll turn it over to our panelists, and I'll be monitoring the chat to make sure any questions that come up do get answered. So we have Leon Lebrecq, the Chief Growth Officer at Sequoia Financial Group. We have Bob Wines at Insight 3 Advisors. Adam Williams, who's a principal at Raymond, and Michael Banish, who's a SALT practice leader at RKL. And I will turn it over to you all as our experts to talk about the implications of the Biden tax plan.
Great, thanks, Rachel, and good to be on the panel with these esteemed experts. Known Bob for years and years and years, and I'm getting to be friends with Adam and Mike in typical nerd out fashion that us CPAs like to do. We put a little slideshow together for you today. We're going to be talking about that. I'm thinking that we should probably recommend pain relievers or some kind of anesthesia because you're going to go through some different things. We will have concepts that we'll talk about. If we do this, it's pretty bad. So we've got some things that we'll probably cover on that. My esteemed panelists, I'm just really happy to be there. Adam and I and Bob and Mike were having a great conversation yesterday, just going through some of the things. I literally had to go get a case of Tums when we were done. So there's a lot here. We'll try to run through them. First and foremost, a caveat, we're not here to praise or disdain the tax system. We're here to talk about it. So this is a roundtable. We're going to talk about what we think could happen. We don't know what's going to happen. Who knows? I mean, this is like trying to predict the future ain't what it used to be. So this is just a simple analysis of the business tax plans from DC. We're trying to stay on top of this. We'll add some things that we've heard, but right now everything is speculation. So nothing is carved in stone. There's some ugly things carved in other types of media, but we'll play with those. I thought what we'd like to do is just kind of set our format. If I could talk, if we were talking about what are the proposed changes in the Biden legislation. Adam, I counted like 35 bills. How many are you counting out there? I counted 35 different tax bills, of which one decreases taxes and all the rest of them raise taxes. What do you see right now, Adam?
I mean, it's a mixed bag of increases and decreases, but it's all against the backdrop that there are tax increases baked into the system no matter what happens. Yeah, so next year, no matter what happens, unless there's an action of legislation, We're going to be capitalizing R&D costs in 2022 and amortizing them over 5 years. And we're also going to be having a new 163J methodology that no longer adds back amortization depreciation. Also, December 31, 2025 seems like a short time from now. And that's when all of the individual pieces of the 2017 Tax Cuts and Jobs Act expire automatically. So that backdrop of increases and decreases that happen without action, whether it's the SALT deduction coming back, or it's the rate going back to 39.6%. So if you look at a lot of the Biden proposals, they don't talk about the stuff that will happen with them doing nothing, because they don't have to worry about repealing 199 Cap A. It's already baked into the system unless they do it.
I wrote an article for Forbes a week ago on change two numbers, raised $2 trillion. Change 21% to 28%, raised 1.2 trillion, and change 2025 to 2021 in terms of expiration, raised another trillion. So it's one of those wild things. So we want to talk about those prospective changes. We want to talk about what the results are for businesses and individuals, probably what we can do about it. And that's where I'm going to call on some of our experts. And then I think we'll try to figure out the odds of the possible consequences of those different things. So guys, why don't we summarize a little bit of what we're looking at? And I think let's just pop through what the main proposals that we're seeing in the big plan. We'll get to the nightmare in the middle here. There's a 12.4% payroll tax assumed. I haven't seen that one come up too much. That one's not in hard print right now. I think they know they can't get it passed. I don't see how they're going to get that through the Senate, because they'd have to invoke the nuclear option, no filibuster. And to get around the nuclear option, you need to get around the filibuster. So you can't get around the filibuster without getting around the filibuster. But that's a pretty negative one, $962 billion of tax increase. We'll cover that in a little bit more detail a little later. Raising the corporate tax rate does look like it's going to happen, don't you think, Adam? Mike and Bob, what do you think? You guys, I think that one's going to we're going to see something, not 28%, but probably 25%.
I think there's a lot of appetite to raise it to 25%. I think the general consensus, they went a little too far. If you look at the OECD, the other major economic countries, 25% seems to be what people are lining up. China, if we're going to, I think I glitched there for a second. If we're going to be at 25%, I think it lines up with other major industrial countries, and that's an easy sell. We don't want to be perceived as a tax haven.
Right. And I think Yellen's move this week, where she was trying to get a minimum tax through the G7, was putting things at 15. I think you're going to see that. That's going to be something in there. So I think that one's got some high probability. We'll handicap that. I'd like to talk, and Bob, maybe you and I can chat a little bit about what that does to markets, what it does to the economy. And I think, Mike, we'd also want to talk about what happens if they have to conform that to pass-through entities. When we did Tax Cuts and Jobs Act, they conformed C Corp rates to pass-through rates with the QBI deduction, with the 199 Cap A. Obviously, if they change the rate to 28%, they'd have to change the QBI deduction from 20 to 15. And that's going to cause kind of an uproar. I was arguing with somebody about the claim that no one under $400,000 would get their taxes increased. And if they change the QBI rate, that changes it pretty dramatically. So I'll leave it at that. The next one down is raising the top individual rate to 39.6 and reinstating some limits on itemized deductions. The raising the rate is pretty much in there. I think that's got some appetite too. Guys, what do you think? I think that's going to happen probably. Easy. It's pretty easy to say you make more than 600 grand, you can pay a little bit more tax. I don't think anybody's going to come. I don't see Washington having that appetite.
Well, one curious thing about that 39.6 rate, it's not $600,000. They've actually squeezed the marginal rate down. And if you look at the Green Book, and I'm sure everybody at home has read all 107 pages of this beautiful document. Yeah, they're going to 39.6%, but nobody's talking about the fact that they have actually reduced where that starts. And they've dropped that down to, I think, just a little below $500,000.
Cool. Yeah, that's going to be a bad one. Let's talk about the nightmare. Let's talk about this one. The cap gains rate and carryover basis. I should move that right there. So we're going to talk about making cap gains taxed at ordinary income rates. And then we're also going to talk about having cap gains having carryover basis. Pop me a little bit on that one. That is probably the most, that's really troublesome to all of us as CPAs.
Here's what Bob's thoughts are on the capital gains.
Oh, we can hit that later. I've got a whole policy issue about capital gains. I sit there and go, what was the policy behind creating capital gains. And if it was basically to incentivize us to invest in assets that promote long-term economic growth, then does it even make sense to have a capital gains tax except more in the flow of a section 1202? And should we be expanding 1202? So that I mean, you talk about throwing a wrench in the works, I might be a really big wrench. So yeah.
In terms of the biggest surprise in, because a lot of these policies have been thrown out through policies, announcements here or there, but in kind of the Biden administration's attempt to return to more normalized legislative process, and they gave us the first time in 4 years or 5 years, the actual document where we can actually look at, what they're saying as far as in paper. The capital gains change, actually, there was a couple nuances that really hit some people pretty hard. The biggest one is that raising the capital gains rate to 39.6% on people that earn excess of $1 million. That is the only item that's in the Green Book where they say it's not going to be effective upon enactment of the provision and statute, but upon what they use the term announcement date. Now, announcement date was not defined, but some pushback by some people said that that's when the president announced it. And if you know, we have the Americans Jobs Plan, which is the individual provisions. The Americans Family Plan was announced when Biden talked to a joint session of Congress on April 28th, which means we may, if they enact this as they've proposed, we actually are in the new 39.6% capital gains rates today. So if they can push this through, that may happen. Personally, I believe that the political appetite to enact retroactive tax increases that are that dramatic isn't there. But that was, I think, the most shocking thing in the 107 pages of the Green Book versus things that have been talked about and discussed by candidate Biden on the campaign trail and just announcements here or there by his administration before they put it down on paper.
Hey,
And
Mike.
this is an area, this is an area that the rates aren't really going to have an impact at the state level. State levels just pretty much tax all income at the same rates. A couple states have a little bit of variation, but not nearly what the feds have. But what's going to be interesting in this, and we'll talk about it later more, is the idea of taxing or realizing gains at death or transfer by gift, and what state implications arise from that. Lots of potential issues with how the states would conform to that, whether they'd conform to that, potential differences in state basis versus federal basis on assets for many years to come, depending on how states react to that. So a lot of unknowns, but interesting issues at the state level on this particular issue, on the potential for taxing realized gains on death or transfer by gift.
Mike, wouldn't that create a gigantic windfall for state governments if you tax capital gains at death? I mean, if I owned a business in Michigan and I had a $100 million basis and it's worth $10 million on my death and we impose a capital gain, I'm getting pounded with 4.25% plus 43.4%. I mean, Adam, you and I were talking yesterday, if you're in New York, you're over 50%. If you're in Hawaii, you're over 60%. I mean, this is crazy. This is like an enormous windfall on the capital gains at death.
Yeah, absolutely. Yeah, the states can just sit back. If this goes through on the Fed side, the states can just sit back and let things roll potentially, and they're going to get a big windfall with no real political ramification from a lot of avenues, because they'll just say, hey, we conform to the federal Internal Revenue Code. They changed the code. We didn't raise your taxes. Talk to Washington.
It would be a massive tax increase in any tax that any state that had income tax. So it would be one of these, wouldn't it? It would be really a bad
But I think
thing.
you're going to see a lot of legislatures look at that and say, what's the impact upon population migration for their most wealthy senior citizens? And they're going to go, do we really want that? If you're in Minnesota, for example, where you've already got a high income tax and you start pounding that on top of it, I think you're going to see a lot of people go like, well, I've already got a place in Arizona or Florida or someplace else, and I'm just moving my residency. So then they're going to look at it and go, look at the impact upon our just general income tax. And some will not have enough, I think, foresight to address it. But I think a lot of legislators, at least hopefully, will go, this is just, again, bad tax policy. We didn't budget upon this. We need to adjust for it.
I would say,
Yeah.
yeah,
Go ahead.
I was just going to say the state tax ramifications is something no one's really talking about yet. And I think
Right.
it's a huge thing. I think that's a huge aspect. And, imagine, Gavin Newsom's, I think, dodging, they reopened California today. He's dodging recall pretty good because California is smoking right now, doing really well. No allusion to their legalization of marijuana, by the way. But California's in that mode. Imagine how much money California would raise with their maximum tax rate if all of a sudden capital gains are taxed on death.
Yep.
I mean,
Yeah.
go buy Nevada real estate.
Yeah.
That's what I had to go do is go buy some Nevada real estate and some Florida real estate, or buy a rental car facility in Florida because everybody's going to move to Florida and Nevada. Or maybe, Bob, you and I could set up our own state. We could buy the UP or buy Belle Isle and set up our own state, have no income tax in that state, but just have a franchise tax or something. Or maybe
That's right. I think, well, like we mentioned about earlier, the state of insanity, it'll be perfect. And
or the state of confusion. We could have the state of confusion. That would be
that would work also. That'd be
Right.
work perfectly. Everyone would want to join us.
Yeah. So we'll need CPAs in the new state, guys. Come join us. So let's go on. Industry specific taxes. I found this one kind of
I'm
ironic.
sorry, Leon, I wanted to touch on a couple more things about the step
The guy
up in
folds
basis
tax?
provision.
Okay. Yeah.
Because the actual sausage of it's very different than I anticipated. So candidate Biden talked about we're going to repeal step up in basis on tax. Now I thought that meant carryover basis through estates, but we ended up having this deemed transaction.
Right.
But they curiously in their green book have not proposed at all reducing the current $22 million if you have a husband and wife with portability estate tax exemptions. So they've created an entire new structure where there's this first income tax on all your appreciated assets. Then that liability becomes a liability of the estate. Then you have an estate tax if you're above $22 million on the full value. So that does get it up to 60, 70% of effective tax rates, as you mentioned, with various states. Now, I'm old enough to remember when that's kind of consistent where it was when I started. I mean, it was a low exemption, $550,000, $650, I think.
Yeah.
55% when I was back in the 90s when I started my career. We're going back that way, but we created a completely convoluted process to get there.
You're talking about a death tax too, don't you think, guys, that we're talking about a death tax on over $2 million. The cap gain tax becomes basically a death tax on any estates over 2 million because that's the exclusion.
Yeah.
250 or call it 250.
It creates a new marginal rate for people.
Yeah.
It creates a new marginal estate tax for people between that $2 million capital gains exemption and the $22 million estate tax exemption.
Right. And all those people now have new problems. Yeah.
Yeah, and I did get a question in the chat about capital gains taxes and what's actually in the proposal. So the member who reached out said he's seen a couple of different instances. So the capital gains tax on AGI, is it the capital gains income 1 million as opposed to AGI, or is it based on the AGI?
It's Adam, it's AGI, right?
I believe it's AGI, but I can, hopefully find it relatively quickly.
Adam, are you truly being a CPA? Do you have that all tagged with little sticky notes too? My man, he's got it tagged. I love it. So that's
Very good.
the kind of thing I did at Plant. In fact, when Bob and I were at Plant. Bob, you and I remember back in the old days when it was 600 grand and all the different estates.
Oh, yeah.
I remember when you and I were at Plant and Frank Moran went on a binge with all our clients trying to get them to repeal carryover basis. And literally every business owner that was a Plant client sent a letter to their congressperson saying, if you vote this in, we're going to support anybody who runs against you. And gosh, it was about 13 days later, I think it was code section 1023 got repealed. It was code section 1023 versus 1014 or something like that, but whatever, being my normal tax nerd self, I'm there. Adam,
So Leon, I got it here. The answer
AGI?
is it's on AGI. So it says the proposal by the Biden administration is that it'll take capital gains rates to ordinary rates, but only to the extent the taxpayer's income exceeds $1 million, $500,000 for married filing separately, indexed for inflation after 2022.
So Adam, let me ask you this question, because I'm playing with this on this deemed carryover basis. If I have a deemed capital gain on death, so let's suppose I've got, a cottage at Torch Lake, and I've got, some assets in my investable accounts. So let's, on death, I have over $1 million of capital gains. In your guys' opinion, does that put my AGI then over $1 million on the deemed death? And then do the heirs now pay 43.4% tax? Or do they have it on their own individual rates? How would you guys perceive that would happen? I know they didn't address that. So we're speculating on how many angels dance on the head of a pin, but what do you think?
I think actually your little fact pattern is much more complicated than you think. Because on the deemed tax, there's actually a bunch of exclusions for certain assets, including residences.
Right.
And I don't know how they're going to define that. So it says exclusions for residences. Is that primary residences, second residences? And there's a bunch of other exclusions from the deemed tax. So it's going to be a very complicated process. I think that, all the estate and gift tax experts are old because it's become, but we're going to have to develop a new young group of estate and gift tax experts to deal with this complexity.
And the Green Book says that the income from these deemed, transfers, or the transfers at death, the realization that will happen is income, quote, on the gift or estate tax return or on a separate capital gains return. And so that question, Leon, of is it in AGI, does it itself cause the AGI to go over $1 million and therefore be taxed at the full ordinary income rates, or is there some applicability where it gets taxed at a lower rate relative to the those who inherit that property or are gifted that property? It's an interesting issue, especially from the state and local perspective, because the mechanism for reporting, which obviously we don't know yet other than what the Green Book says, which is very nebulous, the mechanism for reporting may not necessarily match how it's written into the Internal Revenue Code. So if it's written into the code that it's part of AGI, then I get down to that state and local level, and the states have to make that decision of, do we just go ahead and still keep our starting point at AGI, or do we have a special carve out to remove this? Because to Bob's point, states might like a windfall, but they aren't going to maybe like some of the ramifications of residents leaving the state. So it's a real good question, I think, as to whether it is in AGI or whether it's not going to be in AGI, just because of the way that they've identified that it will be reported. So where will it end up in the code? We don't know yet.
If it's reported on a estate tax return, then that's going to mean anybody with more than $2 million of gains is going to have to file an estate tax return. I think that means we better go find some young associates to go work on our estate planning department, because now everybody there is over 65 like me. So it's one of those weird ones. I got it on you, Adam. I'm older than you. I think Bob's older than me slightly, or he just has less hair. I haven't figured that out.
Well, it's a little bit of both.
Yeah. Wild topic. Let's pick up that a little bit more. I think this is probably one of the scariest ones to me. I really find this one the most onerous. There are some things on industry specific taxes. This is mostly multifamily and commercial real estate, changes on depreciation. Adam, you were talking about some of the other changes we're already seeing. I think they're going to, there's a high appetite to change that. I do find it kind of ironic that the previous president seemed to be in multifamily and commercial real estate, and the current president doesn't like that in their plan. So that's another piece in there. Raising the GILTI tax, the global intangible low income tax rate, is basically stopping some of the corporate inversions by moving intangible assets abroad. Probably my favorite thing that I never got to see is I would have loved to have seen Apple's CFO negotiating with the Irish finance minister. You can only imagine this. The Apple CFO says, well, let's sit down and talk, and let's talk about us moving all our patents over to Ireland and paying taxes in Ireland. And I could see the Irish finance minister saying, well, let's go have a little pint and maybe a little Jameson's. We'll talk it over. And so then the CFO says, tell you what, we're thinking 5%. We think we'll pay 5%. And the Irish, prime minister, the Irish finance minister, no, we couldn't possibly do that. Let's go 1. And then the Apple CFO shakes his head and goes, well, how about we go 3? And no, we'll settle at 2. And that's my final offer after we have another drink. And but dig this, you go make $90 billion and pay 2% tax. That's what this GILTI is trying to get around. I actually think what's going to happen now that Yellen seemed to have made some motion on an international tax, the original proposal, I think, was to do a 25% GILTI. I think you'd see that at about a 15% guilty. And if we get a chance, I'll talk about the investment ramifications of that.
Yeah, in the American Jobs Plan, there was talk about, this 15% global minimum tax calculation.
Yeah.
And Yellen basically announced at the G7 of finance ministers the OECD, that they've agreed. And everybody thought England was going to be a holdout and that this would never happen. And England signed on this 15% global tax. So I think that this is kind of going to get pulled out of the American Jobs Plan, and they're going to conform to whatever document the OECD comes up, and it's basically going to get rolled into a big BEPS type initiative that we're going to have basically a bifurcated tax system. So if you look at the proposals for very large companies, they now define large companies as 2 billion. So BEAT was $500 million as a large company. Now they're at 2 billion for the tax on your global book income, the minimum tax there. So I think that stuff's gonna get stripped out. We're creating basically a bifurcated tax system where large multinationals are gonna have their own tax system separate from everybody else in the local countries.
Well, and kind of they do that now, don't they, Adam? I mean, they now do it through segregated entities, and so they're segregating entities all over the place. So it actually probably levels the playing field a little bit, makes it a little bit, in some ways, a little bit fairer, I would say. Not that although I said don't judge fairness of any of this stuff, I think I could see that. Phasing out the pass-throughs above 400 grand. That's, Adam, what are you hearing on conforming C Corp to S Corp? That's probably the biggest question, because if you conform C Corp to S Corp on all levels, it affects a lot of taxpayers. If you conform C Corp to S Corp only on upper income, what's the status on that?
When you read the Green Book, they didn't really focus. The large S Corp provision that's in here in the Biden proposal is to attach self-employment income, or NIT, to all flow-through income, even if you're active. So the big piece that's in the S Corp world is S Corp active owners are kind of in the sweet spot right now. They can use their own wages for the purpose of generating W-2 limitation for 199 Cap A.
Right.
They can, avoid self-employment tax on the profits they strip out. They can avoid NIT on the profits they strip out. So if you read the proposal, the IRS kind of is throwing up their arms, and Biden's put the proposal on. We want to quit fighting about fair compensation of subchapter S corporation executives, because, it just becomes this big argument every time, and they're going to attack it all. And then you go, well, now what's better? I'd rather pay, do I want to pay self-employment or NIT? It becomes this different, kind of modeling exercise.
Depends on how much you make, right?
Yeah, it's a weird place. I mean, and people think, subchapter S are small corporations. I think everybody here on this call knows there's some gigantic subchapter S corporations out there.
Right.
And there are subchapter S corporations that I work on that have tens of millions of dollars of profits annually that are not paying self-employment or NIT. So that would be a huge hit to those owners.
Interesting. And then final, last but not least, is the weird one that we all know as CPAs. As long as we've had accountants, we've had two sets of books. They're now talking about a 15% minimum tax on book income on companies with over 100 million of book income. In a weird way, this would kind of be like what's going through the G7. I, of course, think it's a mess and a nightmare, but it's, again, only over 100 million. So that puts it in Adam's camp. But the rest of us mortal CPAs, not as many companies with 100 million. I know Adam doesn't even talk to a client unless they have 100 million of net evidence.
Not true.
Go from there. Yeah, I know, I'm kidding. All right, so let's go through how we're going to do this. Let's do the Clint Eastwood approach, guys. Let's say the good, the bad, and the ugly. And so let's say good is, it depends on how you look at it, not many tax increases or small tax increases or later tax increases. I can already tell you there's a 4 martini here, and that's that deemed sale thing where the states all pick it up in AGI and it's retroactive. That's about as bad as I could think. The bad's 2 martinis. That's a middle ground. That's, maybe a corporate tax rate in the middle, some higher individual things, maybe no carryover. And then the ugly is a whole enchilada if we get this whole mess. Most notably, probably the mess that I think we all agree on is the mess of cap gains. So I thought we'd also handicap this a little bit, predicting the future ain't what it used to be. Is this a positive? We think it's going to pass or could pass, highly likely, maybe not so much, or unlikely to pass. So we agree on our rules of engagement, guys. Why don't we go from there? We'll start with an easy one that probably isn't going to pass and is probably really ugly. And that's this 12.4% tax on earned income above 400 grand split between the employer and the employee. This is from Biden's campaign proposals. I don't think it can go through the Senate. I don't think it can even make it. So us talking about what's going to happen, we would be changing everything about how we did things. Adam, going to your kind of combination of how do you get your earned income? Your client with a $10 million sub S would have earned income of some really minuscule amount. They'd have a salary of 80 grand. How much you guys think Jeff Bezos' salary is, by the way? Anybody know? 80
No.
grand. 80 grand.
Probably very low.
Yep, it's 80 grand. That's what he made. He has an 80 grand salary because somehow his tax return got leaked to ProPublica. And I went, look, couldn't resist. So I went over and said, how much does Jeff Bezos make? Then I went home and told my wife, honey, guess what? I make more salary than Jeff Bezos. Aren't you happy?
Yeah. So this one here didn't even make it to the Green Book. This was a political proposal. I don't think it was a serious proposal.
Yeah, I'd agree. And I think
I have a question in chat.
Go ahead.
For capital gains and death taxes, are spouse-to-spouse inheritances excluded?
Yes.
So there is still a spousal exemption in the proposal to tax the deemed thing. So it will be on the second death, just like the estate tax.
Yep.
Thank you.
Thanks, Rachel. All right, let's go to something that probably will happen. So this is raising the top rate back to 39.6. And Adam, you pointed this out. This is going to happen in 12/31/25 irrespective. So that was going to happen anyway. From what I hear from my Washington sources, everybody is already saying this is highly likely. What the question I've got for the three of you is, what are we going to do about it? What do you do about it? Does it mean you try to accelerate income? I'm the big fan of Roths. I love big Roths, and I cannot lie. So I just sit and say, what's going to go on with Roth conversions? Would I do them now? Would I do more on tax efficient indexing, direct indexing? Would I do munis? What do you think? What are we telling our clients? Mike, what are you telling clients?
Yeah, so from a state and local perspective, it's not really on the side of the individual income tax rate, but with the idea, Leon, of what's going to happen in 25 anyway, in the SALT deduction cap, what we're seeing is a lot of states, about a dozen so far, that are bringing out these state and local workarounds for pass-through entities to say, we're going to do a pass-through entity level tax. Instead of flowing that income and making it a tax at the individual level, we're going to do a pass-through entity level tax. It avoids the SALT cap deduction. So we've got about a dozen states that have provided for these elective regimes, and we're doing a lot of analysis to see whether the elections make sense for clients, considering, particularly the idea that these things go away after 2025 as it currently stands because the SALT deduction cap goes away. So Michigan doesn't have this option yet, but there's legislative, process is going on that. I believe it's passed the House and is sitting over in the Senate to do an elective regime, and it's got a 3-year binding election. So do I want to make an election to pay a pass-through entity level tax? Yes, I get the benefit from the perspective of the state deduction, the SALT deduction on my federal itemized for that return, but do I want to bind myself for 3 years on something that's probably not going to continue to exist as a federal issue after 2025? So definitely we're looking at these state pass-through entity elective regimes to see if they make sense for clients. The rate, like I say, the rate issue, that's not a state issue. If they raise the rates at the federal level, there's only a couple states that impacts, Alabama being one of them. But we're really looking at that issue on what do they do with the SALT deduction cap. And I think that's going to just play out its natural death in 2025.
I think we're going to return to the era of 2008, 2009, when we were approaching the fiscal cliff. I wonder what the press is going to brand this one coming up in December 31, 2025, fiscal cliff 2, if they come up with a new word for it. But reverse tax planning for flow-through entities. Just by not making that bonus payment by March 15th and deferring it a couple of days, you can shift income between 2 years, and that will have you can do all kinds of things like that. Elect out of bonus depreciation, go ADS straight line, 59E elections. Each of them, they're different pain points as far as your cash flow. and what the cost of money is to do those things. But reverse tax planning will definitely be on the table. And depending on what the announcement date versus enactment date of capital gains tax, we've got a lot of businesses selling right now. It's a big era of selling small businesses, roll-ups. People are getting out of their businesses because they're 60, 70 years old. The boomers are retiring. And we'll be electing out of installment method. And will that option be available to us based on the enactment date that we have to utilize for purposes of the capital gains rates going up?
So what we're doing is we're doing charitable contributions. When somebody's selling a business, we're doing a pre-sale charitable contribution to the donor advised fund. And I think if you change the cap gain rate around, if it possibly goes around and we get carryover basis, that becomes profoundly more advantageous to avoid 43.4% tax than to avoid 23.8% tax. So I see a lot of boon toward charitable contributions before year end. And actually that kind of countermands, it doesn't matter what the effective date is, it's saving us money either way. So that'll be an interesting one as well.
That's a great option. Just a caveat. I don't know if you caught this last week, but the IRS snuck into their regulatory program new regulations for DAFs, donor advised funds. They're getting grumpy about what they perceive as abuses.
So you got to tread warily. You need to learn to weasel your way out of it. So.
Oh, you got him in there.
I knew I would. Bob was betting.
Every presentation.
I couldn't get the weasel in the picture, but I did. So I got the weasel.
Very good. Very good.
Okay, back to nightmare. Back to, since I'm using my props, back to this one. This is the one we really got to worry about. The piece that bugs me, it's not the cap gain rate on the ordinary income. Although that does bug me, the AGI. It's the carryover basis. Bob, you were going to make some comment on cap gains. I was actually reading Eisner versus McCumber for some perplexing reason, the very first tax case in the Supreme Court, where she was getting, McCumber was getting dividends from Standard Oil in the form of stock dividends. And she won at the Supreme Court level because it said it wasn't a realized event. So interesting and weird how we've come to circle on over 100 years of taxes. So Bob, what's your thought on cap gains?
Just from a policy standpoint, and we've talked about this many times, Leon, it's more in terms of, if we think of it philosophically, why did we create the capital gains tax? One of the primary motivations was to say we wanted to promote long-term economic growth. And we wanted to do it. So we're basically saying, okay, if we're going to do that, if you're investing in a new corporation, great. Section 1202 examples. If you're investing in original issuance stock, maybe of a larger entity, should that be applied? Because now you're putting new capital into a new entity or growth of an existing entity. If you're buying production equipment, that would be a capital asset too, because you're enhancing long-term capital growth for the company, for the country. But let's assume that you've got IBM stock, you've had it for 50 years, and I decide to buy it from you. Are we putting any new capital into the country? Are we expanding the economic growth? No. I'm simply giving you a transfer of wealth. So from a policy standpoint, I'm not saying we should follow this, but does it make sense if we're looking at a policy to even have a capital gain rate, except for investments which are original issuance stocks or assets which we're saying really have a long-term capital or economic impact? And if you look at that as core, you might restructure the whole capital gain tax rate.
But what if I tax corporations at 25%?
I
tax my dividends at 39.6%. And tax my capital gains at 43.4%. Sounds like sooner or later, I'm paying an awful lot of tax on the production of wealth and the gain of wealth. Why don't we just get it over with and say, check your income, send it in, like we used to joke around on the income.
Right. Yeah. We were at Plant Moran. Yes.
I mean, Adam, Mike, do you think that this is clearly double taxation? Is it triple taxation? I mean, is it one of those things? I understand Bob's argument on 1202 about building small businesses, but then I might argue to Bob, well, if I buy your small business under 1202 and I turn it from a 10 million business to 100, I still grew things. So, that's the basis. What do you think, Adam? Mike, what do you think about that?
I think this gets into a political world that I always talk about being politically agnostic when I talk about tax. Just tell me what the change is and I'll go for it. But really, the political argument right now is that have we skewed too far towards subsidizing capital investment versus labor? So me as a guy who mostly gets my income from ordinary income sources that are subject to ordinary income wages, I'm paying a lot higher tax than people who inherited wealth and have invested it. And is that, the question is that are we subsidizing legacy wealth or people who have massive amounts like, the Bezos example? Oh, he just weaseled his way down to only paying $80,000 on his labor. So the labor is, fully loaded self-employment tax. Right now, 37% plus the full SE load is the highest federal tax rate you can pay right now in the current structure. And politically, candidate Biden ran on saying this is not fair. And there's the Elizabeth Warrens, part of his faction, that are, they've got the wonkiness to kind of back up, of this argument.
Well,
Change is good. Change makes me money.
Yeah.
I think we could call it the Equal Employment Opportunity Act for tax attorneys and CPAs. That's probably, I used to think they should have called the TCJA, the CPA Jobs Act. I think this one will be the same thing. Whatever acronym they come up with it, it'll be there. They might call it the fiscal chasm, Adam. I'm liking the word chasm. I think that might be what it would be. It'd be the fiscal chasm. Or I'm trying to think of what you call another one, maybe the fiscal abyss. How about that one? So we could say this is abysmal, and we go into the abyss. So,
but clearly these proposals are buying the argument that we should equalize capital versus labor taxation.
Yep. So
do you guys have any of you guys have kind of a prognostication on the idea of the passage of the increased rates on cap gains versus the passage of the realization event on death or transfer by gift? These things are severable, arguably. So what do we think is more likely to pass, if either?
If I was a betting person, I don't think the step up proposal on death will happen. And I think that capital gains will go up, but they'll go up more to like the Reagan rate of 28%.
I'm in that. I'm handicapping with Adam on that.
I would too. I think
Joint Committee on Taxation said 28 is the ideal rate. That it's already out there. We had it before. It's not like it's a hard sell or a heavy lift. So I think we probably won't have the 43.4, and I can't see the step up going away. They can't go to carryover. I mean, carryover turns into this monster. Although maybe if the state governments start figuring this out, they'll go, oh no, you need to do this. Because as you pointed out, Mike, they probably, I'm going to write a Forbes article, thanks to you guys, on how many trillions of dollars of state tax revenue would be raised by doing this in terms of the deemed death.
Free money.
Free money. Maybe.
By the way, if I was a betting person before the 2017 Act, it would have been completely wrong. So don't put your money on me.
Well, I'm not taking any pools on that. I'm not going to go to the betting. I'm not going on the betting pools on Vegas, although the betting that you can bet on the tax increases. So you can go to Vegas and bet on this right now. So there are ways to do it. And I would say, take a look at it. Obviously, if they do start doing this, we're going to see all kinds of things. 1031s are going to probably change. 7031 up rates, those will probably change. I'm wondering about REITs. That probably hurts REITs too, and some other things.
I actually one of my flagged pages, Leon, is on the 1031 transaction in the Green Book. It's a great disconnect between how they title the section and what it actually does. So the section is titled "Repeal Deferral of Gain from Like-Kind Exchanges." That sounds like 1031's gone, right? That's the title. Then you read the sausage and they say, really what they're going to do for a married couple filing jointly is cap your deferral at $1 million annually. And if you understand the way a lot of real estate transactions work, it's a bunch of people putting in $500,000 into a deal and a promoter getting a carry on the back end, and then maybe a 1031 of that real estate transaction later. Nobody has enough money in probably for a 1031. I have a friend who's a commercial real estate broker. He was worried that they were going to repeal 1031 and nobody wants to sell real estate. And I said, with a $1 million annual cap, there may be actually incentive to churn real estate. You got to keep refreshing your $1 million.
Right. So you keep doing it every year.
Keep doing it every year. So once a building hits $1 million, you sell and you roll it over to another building, you do 1031. Kind of like what, economically theoretically, if you are in California, you should be selling your house every time you have $500,000 of built-in gain in the house, collect the deferral if the rates, if you're in San Francisco and house prices go up, you should be doing that transaction. So we may be creating a real estate bubble and incenting transactions. I don't know, but who knows how it plays out, but this does nothing to repeal 1031. $1 million is a pretty big number still.
It's a big number. By the way, Adam, if you do that in California, that you'd be selling your house every 60 days. So that would be down. They go up about 500 grand every 60 days. I do see this as being a lot of stuff going on with charitable remainder unit trusts. I could see that happening where you'd make these donations to charities, get out of the capital gain again, and then bring yourself back some income. Think about the weirdness of the fact that if capital gain taxes are 43.4, ordinary income taxes are 39.6, I give money to my charitable remainder unit trust, I get an ordinary income tax deduction. I avoid the 43.4 and I give myself ordinary income out of the charitable remainder unit trust. So that's a weird one. And we had talked about this weird estate tax intersection. If they do the deemed sale on death, you end up with capital gain taxes and potential estate taxes. Yeah. And by the way, guys, after 2025, you have estate taxes at half the normal exclusion. So really gets ugly. Boy, I did a heat map, and I'll be happy to share it with anybody who wants to drop me an email. I did a heat map, and the most dangerous spot to be in 2026 is to have more than $11.7 million, less than $23 million, and some substantially appreciated property like a business asset. I did see, Adam, in the Green Book, I think there's a 15-year deferral on farms or something. If you have a farm worth more than $1 million, you can defer that. So they're immediately eliminating our argument. They're trying to get Joe Manchin not to worry too much about the farm folks. I usually like to characterize the four most important people in DC. I used to say it was Powell, Biden, Manchin, and the Senate parliamentarian. Now I'm going to say it's Powell, Manchin, the Senate parliamentarian, and Biden. So we'll go from there.
That deferral issue, Leon, is interesting in the sense of there's different deferrals for a business, small business or a farm, where that would be a deferral, I think, until that business is sold or the farm is sold, versus a 15-year deferral on non-liquid assets that are deemed sold, but outside of that realm of small business or a farm. But the issue being, how is that exactly going to be structured? If it's just a deferral of payment of tax, but I still have that event, that realization event where I'm recognizing all of that in that year of death or transfer by gift, states are probably not going to allow that deferral of the tax payment. They're going to say, hey, we had a recognition event. We're going to tax that in this year. We need you to pay tax, because otherwise you get into issues with, does that taxpayer have nexus at some later point when that tax would come due? And there's precedent for this on the 965 repatriation from TCJA with the 8-year election to pay taxes. States were not generally allowing that. They were demanding the tax that was due in the year of the event. And so if this were to go through at the federal level, and with this option to spread the tax payment, the way it's written in the Green Book, I think you're going to have a lot of issues where federal taxes will be due years after the state tax is due on the same transaction. I don't think you'd see the same deferral by the states.
Interesting.
And Michael knows my theory on this. States trying to tax undistributed foreign earnings under 965 is one of the 10 most offensive things I think I've ever seen states try to do.
Someday we're going to have you do a webinar on what are your 10 most offensive things.
Right, Adam's 10 most offensive things.
I mean, but no state has any right to my undistributed earnings from China. It boggles my mind that they thought they did.
They think they do, though, Adam. That's why.
That's right.
Yep. They a lot of them do.
Adam,
a lot
welcome
of them think
to
they
the
do.
new world. Okay. I did a little study on cap gain tax increases. It does have a market effect. 3 out of 4 times it's had a market effect negative between somewhere around 8 and 20%. One time it had a positive effect, but every time we've increased cap gain rates in the past, we have generally had a decline in the S&P performance 6 months later. I think that's going to correlate to what happens when we look at corporate taxes as well.
Let me jump to a question for you on that then, which is also going to hit into this one, the retirement plan contributions. I'm pushing taxes aside for a while, Leanne. I'm coming to you as an advisor, because many of us as CPAs, people come to us as advisors and saying, what does this mean, these tax impacts upon how I should be structuring my investments?
I think, and we think at Sequoia, that it's not built, the market has not baked in these tax increases. They're not baked into the stock market. In fact, the market hasn't baked in a lot of things. There's all kinds of weird things out there, meme stocks and Bitcoin and all kinds of other things floating around, plus some exorbitantly high cyclically adjusted price earnings ratios where the price earnings and the valuations are up in the sky of certain kinds of entities, Bob. So we think that probably if you're looking at a 28% corporate tax rate, that hits corporate earnings by about 9%. You would logically, ipso facto, get some kind of reduction in the price. You would also logically get a reduction in terms of the cap gain rate. Volatility tends to be negative when it's a tax increase. In fact, it doesn't tend to be, it is in almost all but one case. So I think what you would see is people should be positioning their portfolio as things that they're going to want to keep for a longer period of time, maybe considering harvesting or tempering some gains, and probably clearly rebalancing it for not just this tax increase, but probably a bigger concern, which would be inflation. So we're also thinking that, there's two. So Adam has his 10 things that offend him the most. One of the things that offends me about what's going on right now is the disingenuity of someone saying only people with more than $400,000 will be affected by this act. And if the S&P 500 goes down by 9%, everybody who has the S&P 500 is affected by this act. So, or if it affects all pass-through entities, it affects that. The other one is when the chairman of the Fed says, we believe all this inflation is transitory and it's all going to go away. When I have to pay somebody, I was up in Torch Lake, they're advertising at Subway, $18 an hour to put together a sub. I mean, if you make that 32, Jeff Bezos could make more money assembling subs in Charlevoix than he could working at Amazon. So it's, what happens when you make a wage increase? It's sticky. So there's sticky inflation and non-sticky inflation. So rolled steel will go down because they'll go dig up some more iron ore up in Minnesota. It'll go down. Copper prices will go down because they'll go steal all the copper out of the old houses in Detroit. So we'll get something like that. That'll happen. But in the other end of the scale, or they'll take manhole covers and turn them into iron or whatever. So some parts of inflation will go down and other parts of inflation will probably be stuck. And if my rent goes up, if I'm a nonprofit, my rent goes up because my landlord had all kinds of inflation. It's unlikely my landlord is going to come back to me and say, hey, Leon, by the way, you remember I raised your rent? I'm going to lower it now. And it's unlikely my insurance bill is going to go back down. And it's furthermore unlikely my utility bills are going to go back down. So I think, Bob, people are not necessarily watching their portfolio enough. And we're counseling, let's do a full portfolio review. Let's take a look at where we're at. Do you have stocks that are associated with international? Do you have stocks that are affected by this book income? Where does it go? So there's a lot to it. There's a lot of stuff in there, but the main part is be vigilant. That's what.
Okay, let me ask you one more question, then we can go back to the tax side because I'm looking at the economic side for how we generally can guide our clients. So we're looking at saying we see these things on the horizon. We aren't predicting if they will happen. We're simply forewarning them as possibilities. Now I'm looking at my retirement contributions, my IRAs. I'm walking into your office, Roth. Is this the time at least I should seriously consider doing a Roth conversion if that's on my radar at all?
I'm a giant Roth fan, so I would be trying to get you and Adam and Mike to put money into Roth options wherever they are. Whether Adam at Raymond could go do a Roth 401k, I'd probably encourage him to do that. If Mike could do a mega Roth by making after-tax contributions, Bob, I'd have you maybe do a non-deductible Roth and convert it under the backdoor method and do that, and maybe do Roth conversions as well. The reason is there's a natural inherent superiority to a Roth IRA. It allows tax-free growth for your lifetime, your spouse's lifetime, if you're married to somebody you like and you leave it to them, and then your heirs' lifetimes for 10 years past that. There's no other investment that gives me that arrangement. Even if we retain the step up in basis, it only steps up on the date of death. It doesn't step up 10 years later. But if I give my kids a Roth IRA that I allow to compound through my lifetime, my spouse's lifetime, and my kids' 10-year period under the Secure Act, I've got a natural superiority that's almost impossible to beat. I just did a seminar for the Minnesota Association of CPAs, and the difference is about 100% between a regular IRA and a Roth IRA. And if I put in carryover basis, or if I put in cap gains rate, it becomes superior to every other alternative. So in answer to your question, Bob, if you came in, I'd say, look, let's get invested. B, let's do some Roth conversions, get invested tax-free. And C, let's address ourselves to what we think this economy looks like going forward, and maybe start avoiding some of the things that are COVID type stocks and go to the COVID survivor stocks. Let's find the stuff out there that's going to be better now, not was better 3 months ago or 6 months ago or 10 months ago. So anyway.
And Leon, there is some good news in this. You can look for good news. And if you are a person with heavily tax deferred investments, you'll remember the last Green Book, which was issued by the Obama administration, included a provision that was going to cap the maximum amount of tax deferred money you could have.
Yes, I remember that.
And basically it was going to be pegged based on that, the maximum benefit you could receive from a pension plan. I think that's gone. It's not in the current Green Book. I think a lot of the Obama, the Biden administration is not a continuation of the Obama administration. They have different policy people with different policy choices. The Obama administration talked about repealing 529s. That's not in here.
Yeah.
This seems to be a little more populist, a little more, let's go after rich people, and not kind of what I would call one of the cores of the Democratic coalition, which is college educated people who are, making $300,000 to $400,000 a year, which the Obama proposals would have definitely targeted.
Right, and this doesn't. I agree with you, Adam. It's true. This is definitely leaning toward the upper income echelons, and it definitely leans toward the upper asset echelons, except for that nightmare of, carryover basis on a deemed sale at death, except for that one. That hurts a lot of people. There's a retirement plan contribution credit floating around, an idea of a credit for 26%. There's also, by the way, we haven't talked about this, there's Secure 2.0. You heard it here on the MICPA Roundtable. Secure 2.0 has some interesting provisions. One is to raise the RMD age to 75 from 72. That'll allow us to have bigger IRAs. And Adam, to your point, that allows normal, ordinary income folks who have IRAs as big parts of their assets to save more money because they don't have to take it out as soon. The other thing it has that I don't even figured out at all is it allows a boosted contribution for age 62, 63, and 64. And for the guy on the call who's 65, I don't like that provision. I don't get to put more in my plan, but all the rest of you cats do. Well, Bob doesn't get to. So we get to go on that level. I should have gave this one martini, because if you have a credit for retirement plan contributions, it boosts the market.
Yeah.
Because more people are saving in the market. So I'll give this one a positive. I actually like it. And for those of us in the really high echelon brackets, so what? Get over it. You can either go Roth or you can take the 26% credit and use it.
Question came in, Leon, and the rest of you guys. Someone saying we like Roths as well, but is it reasonable to expect someday Congress will wreck the benefits in the future for Roths? Congress certainly broke their promise on we're never going to tax your Social Security benefits. This is a very long-term prognostication, but what do we think about the idea that Roths might not be the be-all and end-all because Congress is going to go back and change the rules?
They could, I would say, but it'd be prospective. They're not going to do retroactive. Therefore, you're still reaping the benefits up to that point in time. Then you can replan.
If I was a betting person as far as Roths, I would think there would be appetite for mandatory RMD of any remaining balance upon second death of spouse. Basically, this is a retirement asset. It's not intended to be a windfall for your children. So that seems like something there'd be some appetite for.
And I can tell you how you can tax it retroactively. You enact a value-added tax. That way, if you inherit a Roth and spend it on anything, you're going to get taxed on it. So that's the way they could end up taxing it, is putting in a value-added tax or some kind of a consumption tax. And in answer to the question, Mike, I think all of us would say inevitably they'll figure out a way to tax it somehow, way, shape, or form.
Mm-hmm.
Whether they do it in the form of an income tax, whether they do it in the form of value-added tax or excise tax, or they say if you got over $2 million in your Roth, we're going to have an excise tax on it. That's the Obama administration type thing, Adam. We're going to run it that way. But I think we should be destined for that, but we should plan for the law the way it is right now. I think that's a better bet.
Yep.
So I just saw in the chat, somebody came through and said, what's the highest tax bracket for doing a Roth conversion? And that's a quirky thing. There is no highest tax bracket for doing a Roth conversion. There's a cap on contributions to Roths,
Right.
but not conversions. Anybody can convert away anything they want.
And you can convert any amount you want. I was talking to a client yesterday that's got a large estate, old person, older, 80 years old. That's kind of old, not too old from me, but kind of. So if you're old enough to be my parent, then you're really old. But if you're not old enough to be my parent, then you're just sort of old.
And if you wonder why that is, it's actually a twisted revenue raiser that went into the 2010 answer to the fiscal cliff, where they wanted to raise money, so they incented people to convert Roths. So basically stealing taxation from the future to pay for some tax cuts.
So we converted 400 grand. Yes, basically we're going to convert it this year. And we're doing it because it reduces estate tax, because this is a taxable estate. So converting the Roth reduces the estate tax and gets the RMDs out of the person's aspect, and they don't have an ordinary income to the kids who are all in the highest brackets. So yeah, you can convert any amount you want. Estate tax going to go back to the current level, to the old prior level, half the level in 2025. It could happen sooner. Like you said, it's not in the Green Book, Adam, but there's certainly some appetite from Senator Sanders and Senator Warren to do this. They want to change it to 3.5 million and raise the rate to 45%. So any thoughts on that one, guys?
I think the silence is deafening in the Green Book. I think that what they're saying is, we're going to put in these horrible proposals for estate tax. We're going to be silent on reducing the thing because we know that it'll happen by statute, no matter what. And basically they're saying we're proposing this by not proposing any reduction. We're going to take it down to 5.
Yeah.
To me, I look at this and go, why would I invest political capital in getting what I'd call a marginal benefit when most of it's going to come to me if I just wait 2 to 3 years? So just wait. I can invest my political capital on other provisions much more fruitfully than this.
But doesn't this give rise to the opinion of myself and others? Go see your estate planning attorney now.
Oh yeah, you've got runway.
Yeah, there's 2 things. 2025 will happen or you'll die, or both. If you die before 2025, you still got the problem. And if you die after 2025, you got a bigger problem. Don't you want to fix it? So go fix it. Go get
Well, we know there's going to be a problem. Or they're put this way, we don't know. We know that there's a potential. Now's the time to be paying attention to it and be talking to your estate planning attorney. Fully agree.
Yep.
So then a clarification just came through on the chat on the Roth conversion. They were asking, is there a magic rate at which you would be disadvantageous to convert? And I think the answer to that is it's a modeling exercise based on every single taxpayer's different situation.
That's what we do. We model it. Because then you can't just answer that question. It's got to be modeled. And, Secure changed the modeling too, because you only have a 10-year payout for a qualified beneficiary.
It's your opportunity to get paid.
Yeah.
Our favorite answer. Oh, it depends.
Well, that was one of my buddies who asked that too. So he should already know better on that because he's probably the wizard of Excel. It's
Frank. You're right.
Yeah, it's Frank. So and I think this is the time to go think about a lot of 4-letter words. I think you should be talking to your estate planning attorney about things like spousal lifetime annuity trusts or grantor reserved annuity trusts or charitable lead annuity trusts. My favorite is the Yosemite Sam Trust, the intentionally defective grantor trust. But if you can channel your inner Yosemite Sam, you say, you idiot rabbit. And that's, you go through and find the idiot. I like an idiot trust. Actually, idiots are one of my favorite. I love the idiots. I have one myself, and I actually put my life insurance in it. But I think these are things we ought to be thinking about. Lifetime gets big time. In the old days, Adam, you were talking about, we used to have the lowest estate taxes and told clients always to make excluded gifts. I got that back on people's radar. I go, look, go make some excluded gifts. This thing's going to happen. You're looking at this, that 4 years from now, we're going to be going through, and Bob's going to be setting up a new, business for food testing for, old elderly people who have more than $11 million because their kids are all going to be feeding them wild mushroom surprise on New Year's Eve, but 2025. But at the same time, I think you've got to start planning for this now and take a look at interfamily transfers and intra-family transfers. I just think it's going to be the case. Corporate income tax, we know this is probably likely to happen. We've talked about this. I think the ramifications are, what do you do if you have a C corporation? What do you do if you have potentially a pass-through? What does it do there? And they haven't addressed that pass-through issue directly. We don't know whether they're going to change pass-through rates, but they do have to conform them. If they change the corporate rate up, but don't change the pass-through, it suddenly makes pass-throughs much more attractive for the next 4 years. And then we have to go to that kind of angle. Just my overall thoughts is that, you'd want to obviously accelerate corporate income if you thought corporate rates are going to go up and it wasn't retroactive. You'd want to shift away from direct corporate investments. you'd want to use multiple entities and maybe have some kind of a pass-through entity that worked with the C Corp. I don't know, Adam, what, Mike, Bob? What
You
do
know, one of the things is it's kind of, one good thing is we had a bunch of people that flipped from S to C, revoked their S elections to get that 21% rate because they could for reinvestment faster at 21% rate than the fully baked 199A rate. Luckily, we're about 5 years from when people did that now, so they can flip it back again. Well, we may have some C's going to S, we may have some S's going to C. I mean, this always happens when we have any change in corporate rates.
Lovely.
Then in Michigan, you know, from the C to S perspective, got to be thinking about the idea of different apportionment formulas and different, or not formula, but different sourcing on the sales of services, different throwback rules regarding sales of tangible personal property. So federal is generally the primary driver on this, but also need to model out the potential state ramifications of switching C to S or back.
And that good point, Michael. Could you discuss? We have a 1.75 different rate differential between the two. We also have a deduction for C corps for state and local tax, which we don't for flow throughs. So there's yings and yangs.
Yep, sounds like more Excel modeling is in order.
Yes. And I always love yings and yangs. So this is very exciting.
We took a look at what happens if they change the corporate tax rate. I added in guilty, but I think I'm sold by Adam now that Yellen's proposal has gone through. We'll probably see guilty float into a kind of a combined tax. We see it about a 6% bump in S&P earnings, about 1182. I haven't taken the multiple into account. I haven't taken the capital gains into account. And that still hasn't been built in yet, in our opinion, into the market. So the current estimate on 22 is about $202 a share on the S&P 500. Probably drops, like I said, by about $12.
What I would like to see on guilty is some sort of fix for flow throughs with C corps offshore. It is just the difference between a C corp guilty rate and a flow through guilty rate is so egregious right now and so dramatic. You can make elections, you know, that help you a little bit, but it's still a much higher rate. And guilty was written for multinational C corps and the poor flow throughs and S corps that own foreign subsidiaries. Nobody thought of it. The regs don't fix it perfectly, and I hope they can fix it if they pass a bill.
And
So we need absolution for guilty?
if you're guilty.
Good.
That'd be great if they did, because, you know, in Michigan, Michigan is clear that C corps aren't taxed on guilty, but they consider flow throughs and individuals who own 10% or more in a foreign corp to be taxable on guilty. Not necessarily saying we agree with that position. It's an informal position, but that's what Treasury has said. If you're getting it through a flow through, it's taxable to you.
I hate states. We already talked about this. I hate states taxing undistributed foreign earnings. It's just wrong.
Adam, tell us what you really think. Please.
Yeah, come on, Adam, don't hold back.
Never shy.
I don't get the cash.
Yeah.
And I have to pay tax to the state. No.
Oh, the beautiful thing is Michigan says you pay tax when you don't get the cash because of a guilty inclusion, and you're going to pay some tax again when you do get the cash
get the
as it's
dividend.
distributed, because, well, we don't have a deduction for that in the Michigan code. So yes, those individuals owning flow throughs that are passing through guilty, it's a double whammy.
So
It is.
what's the solution then? What is
guilty for flow throughs and 965 for flow throughs. Nobody thought of it when they passed it in the middle of the night, and we're still dealing with it.
So Mike, do you have a solution in Michigan? Are we going to have a solution? Do we have to do it on a state level, or can it be fixed on a federal level?
Well, I mean, it's a state position that you're going to take to, you know, potentially go contrary to what the Treasury has announced in their notice back from January 2020 to say that individuals have to pay tax on guilty. You know, there are some potential arguments to say that guilty is not really in federal AGI. There are some potential arguments depending on the federal elections you've made regarding Section 962 to take positions that this really shouldn't be taxed in Michigan. So it's not an easy fix. I don't think the legislature has any appetite to address it, to change what Treasury has announced. So I think it's just positions that individuals have to take and be willing to potentially fight it against Treasury.
Yeah. So we can't get around it. You're in your opinion.
No.
Too bad. I thought.
And in the Green Book, the big proposal on GILTI is to basically normalize the U.S. rates with the GILTI rate. Because right now, your GILTI rate's so much lower, it perversely incents offshoring.
And inversions. Yeah, it's weird. I did a little run in my research. It seems about 120 companies are impacted by GILTI changes in the S&P 500. So again, from an investment standpoint, we're telling clients, let's take a look at this. Let's see what companies are the most affected. What's going to happen to the earnings of those companies? Are there companies we want to harvest gains or temper gains on now? If I've got a stock that I think is going to go down because of the corporate tax increases, do I take that stock and give it away to charity? Do I harvest the gain, move it somewhere else? What do I do? So some other questions. We have talked about pass-through quite a bit. This is making pass-through income consistent with corporate tax increase and also potentially repealing the QBI for certain high incomes. In the Green Book, Adam, what is it? How much is the repeal on?
Oh, it basically flips it completely around. So right now, if you're, below $400,000, you don't have to worry about the limitations. In the Green Book, it's if you're above $400,000, you don't get it
at all.
Yeah. At all. Yeah. So it basically just lops off everybody that applies the W-2 wages and the UBIA rules and says you don't get it at all no matter what. So only the people below the de minimis that get that benefit of not having to apply those limitations. It will also cure, the SSTB people still get it because they're going to be below $400,000. So it's a nice thing for the people below 400. It's a terrible thing for the people above it.
Right. And I'm also thinking that this will give rise to more people doing multiple trusts, things like 678 trusts, where I can move those around. So I'm not doing, simultaneous trusts, but I think you'd see, I want to give trust to the grandkids, irrevocable trust holding the QBI assets and get those through, try to keep them. Obviously, they're going to be under 400 grand. They can use the QBI, but,
And one thing on trusts, it looks to me, as I was reading through the Green Book, that they intend for the deemed death provision to apply on gifts to trusts, meaning if you make an inter vivos gift, you have, because it's leaving the estate tax system and going to trust, that is going to be your taxation event date.
Yeah. And even going to family LLC. They have any transfers that are effectively considered a wealth transfer from a gift and estate perspective, although clearly not defined, but transfers to non-corporate entities, those would all fall under that regime.
So how would that apply if I'm using a minority discount? If I'm applying a minority discount, which I probably still can do, I could apply the minority discount and then still make the gift. If I could keep it under $1 million, am I okay or not?
I think they're saying you can't apply any discounts. Correct me if I'm wrong, anyone.
I think value is value, and it's a deemed transfer. So I think the valuation rules would still be there. But, I think Leon's raising a good point is, that $1 million threshold, I think it's going to be an annual implementation. You're going to be bleeding into trusts instead of dumping into trusts.
Right. You'll trickle in probably. Mm-hmm. And if you're really big money, you're not going to even have the benefit of doing the trickle.
Right.
Last big one, and the one that I find perplexing but could flow, is minimum tax on book income. This is what I call the Amazon tax, because Amazon was running a $14 billion book income, $968 million of regular tax. They want to throw a book income tax on incomes above $100 million in terms of setting out a book versus taxable income. So this won't affect car dealerships unless you're making over 100 million, which you have a pretty good car dealership. But it will be like LIFO, FIFO accounting methods, all those different kinds of things. I'm not sure this will pass. It might go get wrapped into all the other corporate things. It could get piled into the corporate things. I give it lower probability of passage, but not a very positive thing. It only affects bigger companies. It does affect your portfolio. It is out there.
Yeah, I mean, the size of the companies involves $2 billion of pre-tax net income. So they really raised it, but it's 15%, which is that minimum tax rate they were talking about with the OECD. So it seemed to be this proposal is driving the administration's negotiations with foreign authorities.
I get it.
But you know what, they don't define book income. The words GAAP never appear in here, and it uses the phrase adjusted book income. So that's who knows.
New specialty over at Raymond. Go hire the adjusted book income intern, and you can
That's
get
your third set of books, right?
Yeah,
right.
and it's IFRS book income, is GAAP book income. What about there's some S corps that probably meet this definition, but they're not public. And you know, it's just, it says worldwide book income were corporations with income in excess of $2 billion. They don't define worldwide book income. They don't define corporations. They just give $2 billion, and then the tax is on 15% of worldwide pre-tax book income, calculated subtracting book NOLs from book income, less general. They throw a couple things out, but they never define book income. And, you know, who knows?
So we have a 107-page green book that raises a lot more questions than it provides answers.
Yeah. But I believe that there will be some sort of global minimum tax. Now,
I think you're right. And I would have doubted that until last week. I didn't think last week I would have bet against you. And this week I'm betting with you. I'm going with you on that one.
But they also in the green book talk about repealing the BEAT and replacing it with SHIELD. We love a good acronym. I think that this is an either or. There's going to be some global thing that's going to happen, and the U.S. is going to conform to it.
I'd agree. There are a couple other things we ought to be looking at. There's a drug pricing tax, but Biden has dropped that from any of his proposals that I saw. Senator Sanders wants a financial transactions tax, which everyone loves and thinks is a great idea, that you should pay taxes through your 401k on everything. Carbon tax, which perplexes me if you can sell the carbon credits, which apparently you can do. There is a proposal floating around on a national sales tax. And then, Mike, you've given us some of these state tax implications. Give us the SALT view. What do you think is going to happen with SALT? You're the SALT expert, so let's hear you earn your SALT.
Yeah, so it's one of those things where at the federal level, there are discussions ongoing, and they've been ongoing for years, where the big issues are really on the remote work, coming out of COVID and people learning that remote work is a legitimate thing. Will we get a mobile workforce bill out of the federal government that will make it so that businesses have a much easier time complying with remote work issues across the country? Will we get anything out of Congress that makes any modification to the sales tax landscape after the Wayfair case of 2018 that gave states the right to impose economic nexus on sales tax? So these are things that have been talked about for years. I think it's very unlikely that anything is going to come at the federal level that's going to have a significant direct impact on what states can or can't do. I think what the state ramifications are just trickle down impacts that we talked about through the last hour and 15 minutes. If there's a federal income tax bill that goes through, what might the states do to decouple or not decouple on some of these things like GILTI? What might they do regarding the capital gain realization events? But other than that, I don't see anything coming at the national level that's really going to have a broad state impact.
Cool, that's great. Well, I'm looking at our chat, gents. Anything you want to add as the final pieces? Adam, you got anything you want to add? Bob, Mike, anything else on there as we're closing up here?
No, I think we've covered a lot of ground here.
Yeah. Rachel, do you have any more questions for us?
Yeah, you've gone through everything that we got in chat, and I don't have any more private messages with questions. So thank you all so much for your expertise in going over this today. And thank you to all of our attendees for giving us this time. I know that it was an hour and a half of your day on a very busy time of year. So we appreciate it. as we get more information, we can absolutely host more of these and provide that information to our members as it becomes available. If you have questions that come up after, as you're thinking through the materials or thinking back on the conversation, you can always send them to us at the MICPA and we'll share them with the panelists to get some responses for you. The recording of this presentation, as well as the materials, will be sent to everybody who's on the call. So you can go back and rewatch if you'd like, or flip through the materials that way as well. The last thing I want to mention is we do have a new program this year at the MICPA that we're excited about. It's called Elevate. It's going to be on June 30th, and it's the last day to earn any CPE. So if you're looking to to complete your CPE for the year, check that out. We have new speakers, new breakout sessions, and we're really excited for the content that's going to be in that program. So as always, we're here to be a resource for you. If you have questions, please let us know on anything. If there are other topics that you think would be great roundtable topics, send them our way as well, because we're going to keep providing these for our members to get that information out. And thanks again to our panelists. We really appreciate the time and your expertise today.
Hey, Rachel, and on behalf of all four of us, I just want to thank the MICPA. What a great association. What a great opportunity, and the ability for us to work collegially together. It just shows how, CPAs are probably one of the most important bylines between truth and finance, and where it can really be. And it just allows us to, help out all our clients, but most importantly, just make sure things are recorded accurately and done accurately. So the MICPA is a great harbinger. What a great organization. So thanks so much for what you've done for us. And thanks everybody for watching. Go get your dues up there. See you next week when we're all trying to scramble for A&A credits, except Bob, who doesn't need any A&A credits. Mike, Adam, this is awesome. Adam, you and I are going to go vent about things we hate. We're going to put that up next time. Next time I see Adam, I'm going to ask him to talk about this because he's an expert on it and he's been paying me with these. So I want to go do that. So everybody out there, thanks, Mike, Adam, Bob, Rachel, great being here.
Thanks, Leon. I did
Thanks,
get
everyone.
questions that came in as we were doing the wrap up, asking if this qualifies as CPE. Unfortunately, this doesn't qualify as CPE. It's just a member benefit that we provide to get this conversation going and information to our members. So this does not qualify as CPE, but if you need to look at what CPE offerings are available, reach out to us at the MICPA. We're happy to walk you through that. You'll likely see the materials tomorrow. So if you don't see anything in your inbox this afternoon, don't panic. If you don't see anything by the end of the day, tomorrow you can reach out to us and we'll make sure you get that. Thank you again, everyone, and have a good rest of your afternoon.
Thanks.
Thank you.
Bye.